Hello again, welcome to the Alpha Wave Trader. Week ahead. It's been a couple of weeks since I've sent something through to you, since we had the Queen's birthday long weekend last weekend. And I thought I do want to continue on analysing the S&P 500 because I think it is quite interesting. It'll be a good example of the way I sort of look at things, and I think it's a good from an educational point of view, what it's doing at the moment. So yeah, I'm just going to stick with that just for now, but and we'll revert to looking at a few stocks down the track. Now, when I was speaking to you last, prices were breaking below that level around 2,800 and looking pretty weak. And I was saying to you, you know, it can accelerate to the downside here, but be wary, don't chase it, because it really can whip back to the upside. And we've seen pretty much that occur with people chasing the market down when it was getting weak. And look what happens. This is just so typical. You know, the S&P breaks the 200-day moving average, and the Fed comes out with some soothing words when the market's looking like it might be accelerating to the downside and starts talking about rate cuts, etc., which did a hockey stick save and created the big short squeeze of all the positions that had been put on in this down wave. And this is a key thing that I do look for in these situations, and why I keep talking about that 75 to 87.5% retracement as being a key zone. That's where, you know, most of the positions, as people were selling on the way down, with a big move like we've had all the way back up, nearly, you know, heading to the all-time high there, not many shorts would be sticking it out, and a lot of would have covered their position. And that's sort of how the market moves, constantly creating these waves that shake people out. But that's where the opportunity can come. So this is why I'm looking at this sell zone area in the S&P 500 here. This is a daily chart, and it's just looking at this rally that we're having here. And even though the daily trends turn up, all I need from here is some sort of sign. You know, we can still spike up into this zone, can still head higher. I don't want it heading above that all-time high. So if it heads back above there, look, who knows what's going to happen. And if we're talking about rate cuts and data starts to pick back up again, well, it's blue sky above there. But until then, this can look like another false break. You've seen that high there. It's just taken out the high, and then a big false break, big sell-off. And we've just had another slight false break of the high there. So big resistance around this zone. A good initial clear out, and now rallying back up into the sell zone of that wave. And that's what I'm really interested in. And you see this red box here is also the sell zone of this whole wave higher since the start of the year. And that is a key area to keep your eye on. So a lot of things really pointing to the fact that we may be getting closer to the markets turning back down. And basically we've got the June expiry coming up at the end of this week. And often the market will rally into that expiry because that basically means a lot of the put options beneath the market expire worthless. And the dealers quite like that. So they don't mind spiking the market into that close, but then that can end up creating a situation where there's a bit of a vacuum of buyers once that June expiry finishes. So, you know, we still can rally this week, but as long as we stay below that all-time high, and if the June expiry of the options happens up around this area, I'll be very interested to see whether we'll get a sell pivot after that June expiry occurs. And a sell pivot up in this zone with the market looking the way it does would be extremely interesting, especially for a quick move straight to that midpoint of the range. So of this little range down here, you know, I could easily see a move like that, all back to the buy zone of the range. And there's a lot of dominoes set up beneath the market here. So if we did see something like that, and then it did bust below that recent low just a few weeks ago, which is also below the 200-day moving average, well, then you can see a lot of dominoes pointing to a sharp move potentially to the downside, which would be shaking out people who bought on this leg to the upside from the start of the year. And so that midpoint of that whole wave is the key target that I'm thinking the market can get to. So, this is quite a big move potentially coming, which is, 2,900 to 2,650, and really moving much above the all-time high. You're running away. So you don't have too much of a large risk to take on the trade, and the upside potentially is very large. And look, there's no reason why the market should stop if it does start to accelerate. It can easily start to have that domino effect through this wave. And of course, the buy zone of that would be down around here. So, that would take time. The market always loves thrashing around. But things look pretty interesting as far as I'm concerned. But happy to run away from that point of view if we have the bust out above that all-time high, and then I'll just wait and assess what's going on. So from here, I'm just waiting for this June expiry, hoping we get even another higher move right up into this zone, and then waiting for the reversal, and then looking to take advantage of a bit of a balancing up period back to the downside. So I think that's enough for today. Just a quick overview. Now look, I'll just quickly show you another thing. Looking at these Bollinger Bands and why I have them there, you can see I've got the 20-day simple. That's the main sort of fulcrum moving average for me. 20-day simple, 20-week simple, 20-month simple. And I then have the Bollinger Bands around there, and that's the 1 standard deviation Bollinger Band and the 2 standard deviation above and below, which are the white ones there. And then the 3 standard deviation Bollinger Bands. And how I'm often looking at them, when you've got a trend going to the upside, you're often looking for opportunities around that 1 to 2 standard deviation below. As points where you'd be looking for a reversal, and then a failure through that 3 standard deviation Bollinger Band. And I've got a few little tricks on how to call it a failure. Gives you that sense that maybe things are shifting. So if we're looking at this down move, then I'm looking at that 1 to 2 standard deviation above that 20-day moving average. And you can see, again, to the downside, the great opportunities. We're waiting for the moves into that zone, and then waiting for the reversal, and then you are able to attempt getting onto the move, and just follow on their way to the upside. You can see this really strong trend that we had from the start of the year. There was an opportunity down there back in that 1 to 2 standard deviation below. So from this point of view, we have busted back below that 3 standard deviation Bollinger Band. So that's a hint that markets may be rolling over here. And here we are up in that 1 to 2 standard deviation above. So again, if we break out above that 3 standard deviation Bollinger Band, I'm starting to back off, which would also be above the all-time high. But any sort of reversal up in this zone is looking like a great risk-reward opportunity to try to capture a move back to the downside. So it'll be interesting for us to follow this along over the next few weeks as we head into the June option expiry, and see how the market plays out, so that you can get a clearer picture of what I'm looking for. All right, that's enough for today. I'll come back with more next week. Cheers.